Order block or fair value gap? Which one is the best entry for smart money traders? The answer to this question largely depends on the asset you're trading and what works best for you. However, today, we'll share some valuable insights into both entry types that can be a big help. In this video, we'll start by explaining the concepts of fair value gaps and order blocks in detail. We'll cover the rules for identifying valid high-probability order blocks and FVGs, discuss their trading strategies, and finally, share our personal choice and the psychology behind it. So guys, if that sounds interesting, be sure to hit the like button and subscribe if you're new to the channel. See you after the intro and disclaimer. Here we have a bearish market structure. A significant imbalance between buyers and sellers in the most recent impulse caused this rapid downward push. This supply-demand imbalance can be identified by the formation of fair value gaps, a void between the wicks of 3 consecutive candles. Now, the price is sell-side inefficient, making it more likely to return to the gap area to fill it and rebalance the market. Fair value gap areas can come in different sizes and numbers within a single price movement. Each gap needs a different approach, as we try to enter the market with a specific strategy. For example, in one case, we might see a small fair value gap near a swing low. By setting our entry at this FVG zone and placing our stop below the swing low, we get a good risk-to-reward ratio, with the target set at the close of these candles. This creates an ideal trading setup. Our stop loss is safely placed below the swing low, and our target is the recent high, which has a good chance of being reached even if the price starts to reverse. In the second example, we have a much larger fair value gap zone. If we enter at the start of this zone, we're likely to get stopped out. Even if we enter in the middle of the zone, the risk-to-reward ratio still isn't favorable. We always want to take trades that offer a risk-to-reward ratio of more than 1 to 1. So how should we approach the market in this case? For larger trading zones, we wait for the price to enter the zone and then zoom into lower time frames to find better entry points at a more favorable price. When looking at the lower time frames, you'll likely see a correction as a downtrend. In this case, we wait for the price to show signs of reversal before taking the trade. In the final example, we have multiple fair value gaps within a single impulsive move. The question is, which fair value gap should we choose? The idea is to wait for the price to enter these zones and look for buying opportunities. However, we're only interested in these 2 areas here. Why aren't we interested in the first zone here? If we consider the start and end of the latest impulsive move here and apply the retracement tool, we see that these 2 areas are below the 50% level, which is the discount zone, while this FVG here is above the 50% level, which is the premium side of the range. We're only interested in buying in the discount zone for several reasons. One key reason is that the market tends to take out early buyers. A more conservative approach here is to wait for the price to enter the discount zone before entering the trade. This increases the chances of success and reduces the risk of being caught in a liquidity grab. So far, we've discussed fair value gaps and how to use them as an entry point in different market scenarios. Now let's continue with order blocks. So how do we identify high-probability order blocks on the chart? After the formation of FVGs on the chart, we mark the candle that created the imbalance as an order block. We believe that decisions are made during this candle. Similar to FVGs, if the price pulls back to these areas, it has a higher chance to reject the price and provide us with a great trading opportunity. Order block candles come in different sizes and shapes on the chart as well. When we have a small order block zone, we might consider adding a bit more space to this demand area, or consider setting a large stop if we place a buy limit here. The reason is that, although the order blocks are considered powerful trading tools, rejecting exactly from this box is not a law. So we have to be realistic when placing our stops and entries. On the contrary, if we have a large order block zone, we might consider zooming into lower time frames to find confirmation and enter at a better price to have a reasonable risk-to-reward ratio. With all being said, through backtesting order blocks and FVGs on different pairs, we have discovered that they perform well when accompanied by some conditions. So here are 3 rules for identifying high-quality entry setups when using FVGs and order blocks. Number 1. Aligning with the market direction. Identifying the market direction is generally the first step in analyzing a price chart. We want to identify the trend and determine if the buyers or sellers are in control. We always aim to trade aligned with the controlling side of the market. So, when order blocks and FVGs align with the market direction, they can provide more reliable entry points. In a clear trending market, you can easily identify structure levels, swing highs and lows, and potential trading ideas. If you analyze the price chart and find it hard to see who is in control, it's probably best to move on to another pair. Rule number 2. Collecting the liquidity. When analyzing a price chart, we treat traditional support and resistance levels as liquidity areas, especially equal highs and lows or multiple rejections, which are considered key liquidity zones. But why is it important to identify these liquidity levels on the chart? Liquidity is a key factor influencing price movements. The important thing to understand is that the market tends to move toward levels that contain liquidity. Conversely, the market tends to move away from levels where liquidity has recently been swept. With that in mind, collecting liquidity before reaching an order block or FVGs serves as further confirmation for the price to make the moves we want to see in the market. These key areas can also cause significant price rejections, so it's essential to secure some profits before the price taps into them. Rule number 3. Break of structure. A break of structure occurs when the price breaks through a level that previously held, rejecting price movement. So, what does this signify in terms of price action? It indicates that the impulsive move creating this breakout was not a temporary reaction, but a sign of strong momentum and potential trend continuation. So, a demand area that caused this breakout becomes a stronger signal. By combining a break of structure with order blocks and FVGs, we can identify points where momentum is confirmed and enter trades with a stronger foundation. Now we come to the final and most important part of this video: order block or fair value gap. Which one is our preferred choice? To answer this, it's important to note that both entry types can be profitable. However, the choice largely depends on the asset you're trading, your entry time frame, your trading style, and ultimately, what works best for you. Order blocks may be more accurate for some pairs, while FVGs work better for others. So before placing trades, you should backtest each method on your chosen asset to build both performance results and the confidence to trade effectively. As for us, we prefer entering at order blocks rather than fair value gaps for several reasons. Let me show you a real chart example. Here, we have the euro-dollar pair on the 1-hour chart. The latest impulsive move has broken below this level, signaling strong bearish momentum and the potential for further downside movement. This move has created 2 FVGs, and we mark the candle that initiated these gaps as our order block zone. All of these zones can act as potential supply areas for a selling opportunity. After such a sharp move, it's too late to enter a short trade immediately. Instead, the general trading idea here is to wait for a pullback and look for entries at a better price, aiming for a proper risk-to-reward ratio. The important point here is that, regardless of our entry point, our stop loss must be set above this candle to avoid being affected by market fluctuations. Our first target can be the close of these candles because even if the market decides to reverse, we still expect the price to reach this level one more time. Applying the retracement tool on the latest impulse will show that only this FVG is located in the premium area. As mentioned earlier, we're only interested in selling within the discount zone, so let's remove the lower FVG from our trading list. Now, what happens if we set a sell limit at the FVG area? It increases the chance that the price will trigger our trade, but the problem is that our stop loss would be too large if we place it above this candle to stay protected. Even if we set our order at the middle of the FVG, our stop loss would still be too large, and we wouldn't achieve a favorable risk-to-reward ratio. If we try to set a smaller stop loss, it would be within the supply zone, which is considered a high-risk area. Even if you decide to zoom into lower time frames to find confirmation at the FVG before taking the entry, the odds still work against you, and there's a higher chance of being caught by liquidity grab activities. With this in mind, A more conservative approach is to place our entry at the start of the order block zone. Here, we set our stop above the candle that initiated this impulse and target the close of the most recent market structure. Although entering at order blocks has many advantages, one downside of this approach is potentially missing out on many opportunities. It's common in the market to see price rejecting a fair value gap before reaching supply and demand areas. However, we prefer a more conservative approach to selecting our entry zones. The key point here is that waiting for high-quality trades and filtering out low-quality ones is a vital skill every trader must develop. With that in mind, here's a list of the pros and cons of entering at order blocks versus FVGs. Now let's look at the New Zealand dollar on the 15-minute chart, where we see a strong downtrend. The latest impulsive movement has created a fair value gap. We mark the candle that caused this imbalance as our order block and expect a potential rejection to the downside if price pulls back to this area. Here we've marked a large trading zone, so in situations like this, we can either zoom into lower time frames to find an entry setup within this range for a better price, or set our entry at the close of these candles. But for now, let's stick with the second setup. Since the price is in a strong downtrend, there's a higher chance it will mitigate the FVG and continue pushing down. In strong trending markets, we usually see only small pullbacks, but as momentum weakens, the corrections tend to become larger. Now let's see how this plays out. As we can see, if we had entered at the FVG, we would likely have been stopped out. However, entering at the order block allowed us to place a safer stop loss above this candle. Moving on, the latest impulse has created another FVG and order block. Using the same rules, let's place another entry and see the outcome. The price showed a slight reaction to the order block zone, but due to strong bullish momentum, it broke through the supply zones. So regardless of whether we entered at the FVG or the order block, this was a losing trade. Following this chart, you can spot another trading opportunity if you're familiar with smart money trading patterns. Consider this swing point as the start, and this one as the end of this movement, which was followed by a weak breakout. Here, we have equal highs, making it a significant liquidity level. Notice the long wicks, indicating that substantial short trades have been executed in this zone, with stops likely set just above it. If we look to the left-hand side, we also find an imbalance and another order block just above this liquidity zone. This provides a promising trading opportunity for smart money traders. Now that the price has pushed above these equal highs and triggered liquidity, we expect a rejection at the order block zone, with a likely continuation downwards. So, we place a sell limit within the trading zone and set our stop above the swing high. But where should we set our target? Looking at the price structure, where might we find an important support area? If you guessed this bullish order block, you're correct. Once the price reaches this point, it's uncertain whether the bulls or bears will take control. According to the concepts we've discussed, the bullish order block just ahead of the price should act as a strong support level and could push the price higher. Therefore, we want to set our target at this zone. Once the price taps into that zone, we should observe the price action carefully before making further trading decisions. Now, as you can see, the third trade would have been profitable regardless of whether we entered at the FVG or the order block. However, the order block entry provided a better risk-to-reward ratio. On this trading day, we had one losing trade and two winning trades with a risk-to-reward ratio of more than 1-to-1, which is great. However, when trading in live markets, you might experience multiple consecutive losses. That's why it's essential to have a solid risk management plan to stay in the game until the winning days arrive. So guys, I hope this video brought you value. If it did, please hit the like button to show your support. And if you're new here, consider subscribing to our channel, as we cover many advanced trading concepts. See you in the next episode.